UHY Corporate Finance. I'm joined here today with my colleague Wiley Lane. Again, I think our names may be switched on the screen here, but we'll push through regardless. So yeah, we're really excited to talk to everyone today. Really the goal here obviously is to provide a staffing M&A market update and really provide some real world recent insights into what we're seeing in the market today, and hopefully provide folks with some action items relative to whether or not you're a buyer or a seller in today's staffing market. So, the agenda for today, I'll talk a little bit about, who is UHY Corporate Finance, give you a bit of context around Wiley and my team on the investment banking side, and then we'll get into, what does the general M&A market look like today? Is now a good time to sell my staffing company? And, by the way, some of this content is sort of either sale-oriented or acquisition-oriented. That being said, a lot of the learning points on the sell side will be applicable to buy side and vice versa. But so we'll look to dive in, obviously, to a very detailed update on what we're seeing in the staffing world today from an M&A perspective. Talk a little bit about deal process and deal terms for buyers and sellers, and then really what are some next steps for business owners in the staffing space today. So with that, I'll kind of jump into a brief kind of discussion on, who is UHY Corporate Finance. So we are a full service investment banking group backed by a global attest tax and consulting firm that is UHY LLP. UHY LLP, we're almost 30 offices nationally, and we also have feet on the ground in over 100 countries globally. So we really have a strong national presence and a global presence as well. If you're a buyer of staffing companies internationally, that can be helpful in that regard. And obviously, if you're selling a business, we have access to international buyers as well. Big Four experience throughout the firm, focused on the middle market. And again, UHY Corporate Finance, we're really a boutique investment banking firm supported by a lot of tax and accounting resources that frankly most investment banks don't have access to. So provides us a lot of help when we're in market, looking at and evaluating targets and helping our business owner clients prepare for a sale transaction. We've been very busy, as you'll hear in a minute, so has everyone else. The broad M&A market has been highly active over the last several years. So too has activity in the staffing space in particular. Our group is really industry agnostic, like a lot of boutique investment banks. So we work across industries. That being said, there are some industries where we'll spend a little bit more time. Staffing is one of them. So, we truly have a staffing focus within the investment banking team. Similar to the accounting side of our firm, we have true Wall Street experience with a middle market focus. So, all of our clients are, hopefully like a lot of the folks on the call today, business owners in the middle market, privately held businesses. And that kind of transitions nicely to a national staffing practice. So UHY is really unique in that regard. And, from the tax and accounting and CPA side of the firm, they benefit from having, our group's resources on the investment banking side and vice versa, right? So we really get to tap into a lot of tax and accounting resources to bring to bear for our clients. So our national staffing practice, about 25 professionals, cross-functional. So that's on the investment banking side, on the accounting and attest side. So think annual reviews, annual audit type work, tax services and consulting services. But again, the key there is with a focus on staffing, which is really critical. Staffing is one of those industries where, if you're a CPA in staffing, that there are things that you otherwise would miss if you didn't know the industry well. So that's a real significant asset for our group and for our clients. So significant industry experience in staffing. We have over 200 staffing clients across the U.S. And members of the national staffing practice are highly active in the community. So, community board positions on a lot of the staffing associations, SIA, ASA, NYSA, TechServe, and otherwise. And kind of to sort of set up the rest of our discussion, we've closed 3 staffing sale transactions in literally the first month and a half of this year alone. So we've been very busy. We've got a very good pulse on the market today. And we've got also multiple sale transactions in market, and multiple buy-side engagements where we're really on the other side. So the majority of what you're about to hear about today is really sort of what we're literally seeing in today's M&A market. So again, UHY Corporate Finance, a full suite of investment banking services. I'll kind of flip this page relatively quickly, helping business owners that are looking to pursue a liquidity event or a sale transaction, whether that's literally today or they're preparing to do so over the course of the next 3, 5, or 10 years. Also working with private equity funds that have portfolio companies, helping them pursue liquidity events. We worked on a few carve-out sale transactions recently. And then, what you'll hear a lot about today is this pre-sale preparation process and evaluations. Our team has been very busy working with a lot of business owners, particularly in the staffing space, that are looking to just really understand and get informed, right? So I'll talk more about our pre-sale preparation process later, but it's really sort of getting everything in order and understanding, how your business compares to others in the market and to your peers, and what does that mean for your valuation, and what can you do in the years ahead to really focus on value creation as you're looking to allocate investment dollars and resources and sales initiatives. On the buy side, we run a lot of buy side search processes, which is working with business owners, determine how you want to grow, right? Are there certain geographies and states you want to enter? Are there certain service lines you want to add or bolster as a firm? So really understanding how are you looking to grow? And then we basically canvass the market, and we have a very targeted and focused outreach strategy to find acquisition targets and assist in closing those deals. We also help business owners raise capital, typically debt capital for growth, and then we do a lot on the due diligence side as well. Some members of our team are focused on due diligence, and a lot of it is M&A focused as well. So we're doing a lot of sell-side quality of earnings reports and a lot of buy-side quality of earnings reports, and we'll talk more about what that means later. And then finally, we're doing a lot of modeling and forecasting. A lot of business owners, if you don't have debt, you don't have to prepare a forecast for the next 12 months, don't really have a lot of time and effort put into the forecast. And so we're working with a lot of business owners, either in preparation for an eventual sale or just to get a better sense on how your company's growing over the next couple of years. That's another area that's kept us relatively busy as of late. So with that, let's jump in. And before we really get to the meat of the conversation, I think what a lot of folks are interested in hearing about is what are we seeing in today's staffing market? Given what's been going on in the general markets today, we figured we'd start off a little bit higher level, a little bit of a macro lens on what are we seeing in general M&A. So, first and foremost, there are a lot of warning signs flashing out there today. If you read the business or financial press, you really can't miss it. There's a lot of market uncertainty, probably more so than we've had in the recent past. And it impacts the future and the view towards the next few months and the next couple of years. So interest rates are increasing. The Fed has been very active and is likely to continue to be so. The expectation is that rates are going higher in the September Fed meeting. And that's something that impacts the markets from a financing standpoint, both businesses and consumers. Obviously, those rate increases are due to 40-year highs in inflation. The Labor Department announced today that we're at 8.6% inflation year over year. We've come down a little bit, but that is significant for the economy and something that we're working through. And then, the term that nobody on this call wants to hear is there's been a lot of talk of a recession, either in the next 6, 12 months or so. It's a scary word. A lot of folks think we're already in one, right? We've had 2 negative growth quarters of GDP, typically an indicator of a recession. And then we've got some folks that say, how can we be in a recession when unemployment's at 3.5% today? And then, of course, you sprinkle in some geopolitical uncertainty, obviously the war in Ukraine that's been ongoing, and then we have Taiwan as well. So a lot going on, a lot of market uncertainty. And so then how does that kind of filter into the markets? US M&A overall is down about 40% through July of this year versus last year. I will say that a little bit, it kind of sounds worse than it actually is for a couple of reasons. First of all, 2021 was a record year of M&A, not a normal year, a record year. So the fact that we're down, I think, hasn't caught anyone by surprise. And also a lot of deals that probably would have counted towards that 22 number got pulled into 2021. Wiley and myself, we probably worked on 3 sale transactions that closed literally on December 31st of last year alone. Again, those deals probably would have in the normal course occurred in 22. So a couple of things that sort of make that number seem a little bit more negative than it actually is. But there's no question that there's been some disruption in the market, and we're seeing M&A slow down, at least on a large scale for large cap public companies. And while I'll get into this more later, but just to provide a relative data point here for staffing M&A, while overall M&A is down 20%, staffing M&A is down about 20%. And we'll get into some of the factors that are driving that. One of which is that the buyers in staffing generally are private staffing companies that are funding these deals through cash on the balance sheet or existing revolvers, whereas large public companies, private equity funds, tend not to be as active in staffing M&A, at least historically. And those are the buyers that are seeing a little bit more challenge in today's market as they've got to raise more external capital. So leveraged buyout activity down 20%. And then, as I mentioned, right, there's large M&A deals that are getting actually pulled from the market, which is never a good sign for broad M&A. So the transaction for Kohl's was canceled in June due to financing challenges. A Goldman Sachs-led sale process for Walgreens Boots in the UK was recently pulled due to lack of interest and challenges with financing. That being said, other deals are moving forward, and even more deals are getting announced daily. So obviously JetBlue is moving forward with its acquisition of Spirit. Amgen and Pfizer have been very active in the last couple of weeks. So it is a bit of a balanced view. There are definitely deals getting done, which is great, but we do see deals getting pulled from the market. So, as M&A professionals, that's on our radar, something we're monitoring. Again, in the middle market where most of us operate, we're seeing a little bit less of that activity happening, but it is something that we're aware of. For business owners, obviously an important topic is what's happening from a valuation standpoint, right? And so, valuations have declined. One good data point from our perspective is the S&P 500, right? What are public companies trading at today, and where were they trading at historically? So the S&P is down about 14%. Of course, we printed this yesterday. I think we've seen a rally today, so we're down about 12.5% today. So, but we've been down over 20%. So the good news there is we've recovered, and the market is fighting its way back, but we're still down from a valuation standpoint. And how does that translate to the M&A market? Obviously, sellers want yesterday's prices that were higher, and buyers are looking to pay today's prices, which tend to be lower. I think that kind of illustrates one of the biggest challenges for M&A, including in the middle market that I focus on, which is a value gap, right? So anytime you have a gap between sellers' expectations on value and frankly their requirements to sell and buyers' expectation on value, that usually slows things down from a deal market perspective. So the next couple pages here really kind of illustrate some of those points. So the top chart here, this is overall, not just staffing, this is overall U.S. deal activity. You can see that big bar in 2021, clearly a long-term record for overall M&A in the U.S. It's about 2.6 trillion of deals announced and closed in the year. And then more importantly, we see this green bar, which is really kind of showing the year-to-date period in 22 and how that compares to the same period last year. So again, we're down last year, but again, as I mentioned, it was a record year, and frankly, a lot of that 2021 deal activity was probably pulling some deals from the first quarter of 2022. The second, at the bottom of the screen, we've got kind of U.S. private equity valuations, really what they're paying for deals historically. Again, this is the broader market, but this really illustrates a couple of themes. First of all, valuations are still at very much long-term highs overall, so really good news for sellers and business owners. We do see a trend line down, of course, from 2020 through 2022 year to date. We're not going to spend too much time on this topic. I don't want to get too far into the weeds because I know a lot of folks maybe aren't finance professionals, but when you talk about valuation multiples in an M&A context, we're talking about the numerator being the value of the company which is forward-looking, right? So, for instance, the future is not, we're not expecting another COVID situation where businesses are generating zero revenue for 2, 3, 4 months. So the value of the company is the numerator looking forward. The denominator is, of course, the trailing EBITDA number. So in 2020 and early 21, we still had businesses that were literally shut down for several months, and so their EBITDA number was artificially deflated, which means the numbers you see on the page in 2020 and 2021, frankly, were a bit artificially inflated. So again, I think that sort of overemphasizes what the decline here, whereas I think, certainly 2022, we're still seeing very strong valuations in the market. The next page here, really what's the driver of that activity? Private equity on the top here, you can see it has raised record amounts of capital in 2019 through 2021. Even as it's declined year over year since the record in 2019, you can see that even 2021's activity is a benchmark year looking back over the last 12 to 13 years. And then finally, another term or metric that folks in the investment banking community monitor is private equity dry powder, right? Continues to rise, about 3.4 trillion today. This is basically capital that is literally sitting, waiting to be invested in the market. And on top of that, you've got, these funds are raising debt as part of their deals as well. So there's a tremendous amount of capital that has to be invested in the next 3, 4, and 5 years. So again, I think relative to the middle market, I think we're going to continue to see a nice bid out there to continue a strong M&A market. So again, that's kind of the M&A market at a very high level. I think what most folks are interested in hearing about is, what's going on in the staffing space, and I'll hand it over to Wiley Lane to spend a little bit of time addressing these topics.
Appreciate that, Jeremy. Of course, why you're all here is to learn more about staffing specifically. So it was great that Jeremy had a chance to go through kind of the broader macro M&A landscape, but kind of what we're going to do over the next few pages, kind of dig in more deeply into both kind of the larger staffing industry and then dig a little more into the subsectors within staffing. So kind of headliner on this page really is the staffing M&A market. There's been a lot of great activity, but the best thing is that we're beating the public equity markets, which is in line with kind of the strong jobs report in July and the generally low unemployment, because of course, staffing is in the business of labor. The other key point is we like to refer to it as more of a regression than a decline, because what's really happening is we're at or above pre-pandemic levels in terms of deal activity. We're just coming off an absolute peak record year for M&A, which occurred in 2021. And as Jeremy said, there was a unique push-pull dynamic relative to kind of the tax concerns. So a lot of deals that might have been closed in early 2022 were kind of pushed forward into late 2021. So kind of high level points from a seller's perspective, there are buyers who remain highly active. We're doing more buy sides than ever before. And just for context, the buy side is when a staffing company or a private equity group reaches out to us and we basically search for, target, and potential targets for acquisition for kind of these groups. And we're receiving lots of responses. So from a buyer's perspective, I mean, hit rates on these calls and reach outs are usually around 5%. We're seeing hit rates as high as 25 to 30%, which tells us that there's going to be a really strong pipeline for M&A in over probably the 18 months or even 3 years. So that's really great news for buyers. And for sellers, I think there's a lot of great companies out there, and there's a lot of opportunity to get great values. For overall, strategics are dominating. And when I say that, what I mean is most of the companies acquiring staffing companies are private staffing companies, like many folks on this call. But what's happening recently is the increasing value of talent is making investing in this theme more attractive to private equity groups. And we're seeing more and more private equity groups kind of getting in on this deal activity more recently, and we expect that to continue. Just to illustrate, we reach out to private equity groups on every staffing deal we do, and every new deal, we're seeing new names in the mix. So that's obviously great news for sellers. A larger buyer market is fantastic news. So moving on here, so we've addressed the broader M&A landscape. We've talked about the staffing industry as a whole, but we can't stress enough how important it is to look at subsector M&A activity. And kind of what we're trying to illustrate on this page is we've basically broken down M&A activity by subsector, which in this case is IT staffing, healthcare, light industrial, professional, executive search. And really a high level takeaway from this page is that we have IT and healthcare leading the way, up from about 50 to 55% of all deals in kind of pre-pandemic, during the pandemic, to about 60% now. Most of that's driven by healthcare, which has obviously experienced pretty explosive growth recently, given the obviously increasing demand with COVID and very limited supply of nurses. I mean, we've seen an explosion, particularly in kind of travel nursing. Light industrial, professional, executive search, those tend to be fairly consistent. Light industrial might vary year to year on because of kind of they're tied to more cyclical markets, but generally they're fairly kind of consistent. So that's obviously great news. And obviously there are a bunch of other kind of dynamics that drive these things, but we just wanted to give you a picture of what's happening from a deal activity perspective. So kind of know how many deals are happening, but what types of deals are happening. So we've mentioned several times, both Jeremy and myself, that private staffing companies are the major acquirers in staffing M&A. So we know private equity is starting to enter, but it's really strategic buyers. And I think the important number on this page, look on the top right, we've broken down private versus public. And it's really private staffing companies doing about 2/3 of deals, a little more than that, because public, although they've been acquisitive, they're a bit more selective. So that's kind of something to keep note of. I mean, we've pointed out in the bottom left, there's a lot of deals getting done, several large deals getting done. I think these three put on this page kind of illustrate some of the points we're trying to make. Korn Ferry's acquisition of ICS, for example. Korn is one of the more acquisitive publics, but again, they make up a pretty small portion of the overall deals relative to private companies. So the fact that they're kind of investing in ICS, which is a big IT professional company, says a lot about kind of how they see the value. And I've kind of done a lot of research in that particular deal. And kind of one thing ICS does is they do a lot of data-driven recruitment. Their process is very data-driven. I think when you think about public companies, they're trying to add new assets to their business. What do they not have access to? And I think that's their goal, which is why they're so selective, because they're looking for companies that do really unique things. HIG Capital, we've talked a lot about how private equity is getting more involved in the staffing space. I mean, here you have a major private equity group investing in a healthcare staffing business, which obviously we mentioned has exploded in recent years. And you'll see in a chart later how large that kind of growth has been. You've kind of major players merging together, Tech Partners and Genuine have just formed Inspire. So I think that's illustrative kind of the fact that deals are still happening and there's a lot of opportunities out there for aggressive buyers and kind of eager sellers. Last point on this page really is what we've noticed is that kind of larger deals around 100 million plus are increasing as a percentage of total deal value. And really all it should tell you is that kind of private equity groups are getting more involved, because the private equity kind of value prop is what they do is they come in and they usually invest in a larger platform. So their first investment in a space is usually a pretty sizable company, and then they go from there. So the fact that this number is going up is exciting because it means private equity is getting more involved, which obviously means more buyers and more aggressive buyers. So obviously we've gone through types of deals, activity, but you're all here because you want to know what's the value of your company. So a tool in our toolkit is basically we look at kind of large public players to see where they're trading at, to get an idea of kind of where the private markets may be trading. We want to preface this by noting that these are all large public multiples. So public companies are obviously much more diversified on a customer, services, and geographic level, in addition to having almost unlimited access to capital and obviously being multi-billion-dollar companies for the most part. So they trade at a premium relative to the private markets, but I think this is illustrative kind of the general trend in the market right now, which is that valuations right now are at or above pre-pandemic levels. So they look like they've declined from 2020 to 2021, but as Jerry mentioned earlier, I don't want to dig too deeply in here because we can really get into the weeds relative to valuation, but they're really distorted based on kind of the impact of the pandemic, and the 2022 year-to-date number is much more representative of the valuations public markets will see today and going forward. So last page basically touched upon how valuations for staffing companies can vary pretty widely. That being said, kind of the subsectors we've already gone through: healthcare, IT, professional staffing, light industrial. they tend to trade in target markets, and we presented target ranges, apologies. We presented some of those ranges below. And for sellers, basically, if you're kind of looking to manage expectations or see a starting point, or if you're on the fence about whether or not to buy, this is a great place to start. For buyers, if you're preparing an indication of interest or letter of intent, this is equally a great place to start, because obviously these ranges we provided are obviously only reference point, and any one of these businesses can trade above or below these ranges based on the tangibility of growth opportunities and how strong their performance metrics are relative to their peers. So light industrial, commercial staffing tend to start in the 4 to 5 range. They tend to have lower gross margins relative to the broader staffing industry because they have made lower scale placements, think day laborers, and they're tied to more variable markets. 5 to 6, you'll see professional staffing right in the middle, and healthcare and IT staffing, both industries which have had pretty explosive growth in recent years. The key driver there is they have really premium, high-skilled placements, which tend to be higher margin, and obviously industry tailwinds have been extraordinarily attractive for both strategics and private equity, who have, as we've said, have kind of moved into the staffing space pretty aggressively in recent years, and we're hoping that will continue, expect that to continue going forward. And obviously, we want to stress these are really just reference points. The only way to truly know is to do evaluation. And just from our perspective, we're doing more evaluations for prospective sellers than at any point in the last few years, which is really exciting. We're doing more evaluations and pre-sale preps. I know Jeremy's mentioned that as well, for staffing companies specifically.
Yeah, great. And I'll kind of jump in here as well. And again, as Wiley mentioned, these are sort of starting points. So, if you pick up the phone, you call private equity funds, how do you value these companies? These are sort of the ranges you're going to hear out there in the marketplace. But let me give a little bit of context around the ranges and what can sort of, let me give an example of, some things that might put your company at the lower end of the range, or frankly, even lower than these ranges, would be, unique dynamics about your business, right? Is the ownership and management team departing after the closing in a year or less, right? So if I'm a buyer and the team is departing, I know that before I can focus on integrations, synergy, optimization, I've got to find a new team, right? So generally that is priced into the deal as a bit of a discount, a little bit more risk as to whether or not they're going to find the right person and that they don't skip a beat operationally. A lot of companies that are selling themselves that don't have an investment banker or a good M&A attorney and aren't represented well tend to trade sometimes at the lower end of these ranges as well. That may sound self-serving, but I will say that, we work on the buy side and we represent buyers of companies. And one of the first things that we're trying to sort of feel out and understand is if we're talking to a seller, we want to know, do they have an investment banker? Are they well represented? Do they know what they're doing? Do they know what deal terms are? Do they know what valuations look like? And we kind of feel out their process a little bit. And if we feel like the answer to some of those questions is no, well, then we generally drive our value lower. So, and that's the same thing again on the sell side. Again, poor data, that's another issue, right? So as a buyer, the buyer has to get comfortable with your business, whether it's going to keep performing at current levels. And so they have a very data-driven due diligence process. So if we as a seller don't have good data or good financial systems, whatever the case may be, the only real way for a buyer to get comfortable with that and de-risk that issue is with a lower purchase price. So just to give you a little bit of context, and on the other side of the coin, what are some things that could drive value higher than this, right? So obviously, if your company is growing faster than your subsector peers, that would warrant a higher premium value, everything else the same. Do you have higher margins? Do you have a strong team that's sticking around for 3 or more years? Again, if I'm a buyer and I'm looking at this business, and I know the team's going to be there for the next 3 years, I can focus on growth, optimization, synergies on day one, and I don't have to worry about succession planning for, on the next couple years, which is what they prefer. And then finally, does your business have any other unique attributes? Maybe you've got some kind of embedded placement technology or proprietary technology that most companies don't have access to. So those are some of the things that could drive your valuation to either the higher end of these ranges or far beyond potentially. And one example would be, on the light industrial side, for example, we're working with a business right now that has some great technology, and frankly, their valuation is going to look more like 6 to 7 times. And so, again, there are ways to move kind of beyond these ranges, but as Wiley mentioned, these are kind of the general starting points. And you know what, I'll kind of cover this next page here as well. This is really meant to illustrate the point that we're talking about here, which is, let me give you some illustrative examples. We were talking to a lot of business owners in 2020, obviously a very challenging year on a number of levels. But we had some business owners that said, look, I can't sell my company now. I was expecting to grow 30% in 2020. Now with the pandemic, I'm down 10%. When in reality, if they're a professional staffing company and the overall subsector is down 16%, if you're only down 10%, you're actually outperforming your market, right? And that could warrant a premium valuation for your company. So it's all about that relative performance. And likewise, if you generated 10% revenue growth and you're a healthcare staffing company in 2021, you may think you're doing well, you're growing the business, when in reality, if your peers are growing at 85%, again, you might be underperforming the market. So the message here is, valuation is not simple, it's very complex. Again, I think those starting point ranges are helpful, at least at the outset, but then beyond that, you're really going to kind of dig in and understand a number of value drivers to really get a better sense for what your business is worth, or if you're a buyer, what the target company that you're evaluating is worth in today's market. So from there, I'll talk a little bit about deal process and deal terms, both for buyers and sellers, and I'll kind of break it down into 3 categories. So we'll talk about the pre-sale preparation process. Again, all the kinds of things you can do just before a year or 5 years before a sale. Then we'll talk through the sale process itself, and then we'll get into some of the deal terms that buyers and sellers need to be focused on in a transaction context. So Wiley, if you want to flip to the next page here. So basically the pre-sale preparation process, there's really kind of 3 legs to this stool, right? So if you're a business owner, you're thinking about selling, or you at least want to know, are you ready to sell? And is your business valued at a value that makes sense for you to move on and sell? So the first step here is getting a really good sense for your historical financials. As I mentioned before, when we talk about valuation in an M&A context, buyers are most interested in what was your revenue and EBITDA and cash flow in the last 12-month period, right? So if you do an audit or a review, those are your internal financials, right? We want to look at your financials from a buyer or an investor's perspective, which frankly can be quite different, right? So I would say that in most transactions, the adjusted EBITDA number that buyers are applying a multiple to, between 20 and 25% of that adjusted EBITDA number is add backs and adjustments to your internal numbers. So if you're not, if you're picking up the phone because someone called and said, hey, I'm interested in buying your company, and you send them over your financials, you're probably missing that 20 to 25% and indirectly potentially leaving significant value on the table that the buyers will benefit from. So step number 1 is digging in on your financials historically, representing them in a way that a buyers will look at your numbers. We can talk more about that or certainly answer questions about that, but that's a critical first step. Secondly, if I'm a buyer, I really want to understand the historical financials because that's the last performance you've actually generated. But frankly, I'm a little more focused on the future, right? Because I don't really, as a buyer, benefit from your historical performance. So the next step is getting a very detailed bottom-up forecast built. It's more critical than ever. The reason for that is if buyers are paying premium values, and as we'll talk a little bit more about later, coming to the table with more cash at close, they really got to make sure they have confidence in your business and the outlook for your company. So whereas historically as a seller, you may get away with saying, look, we're going to grow 10% next year or the next 2 years, great. That's no longer enough in today's market. So what we're helping business owners do, and many already have this in place, but a lot of folks don't have a forecast, or maybe they're doing some very conservative budgeting for their lender or their bank. What we're trying to help business owners build out is a monthly forecast from revenue down to adjusted EBITDA for, at this point, the rest of 2022 and into 2023 for the full year. We're really trying to get buyers and investors as comfortable as you are as business owners from the outside looking in, and that's a critical step in the process. So once you've got your historical financials in order, we've got a good, reliable forecast for what the future looks like, then we're running a valuation analysis. And when I say evaluation analysis, there are a lot of different valuations out there for estate planning and taxes and otherwise. What we're talking about is, what is your business literally worth from a buyer's perspective in today's market? So, you know, historical financials, forecasted financials play a big role in that. And then we're also considering, do you have proprietary technology? Are there other attributes of your business that should drive value? And so upon completion of a pre-sale preparation, it's a very eye-opening experience for business owners to go through, especially those that really haven't dug in on some of this analysis in the past. I've seen business owners that say, look, I'm ready to sell. When they complete this analysis, they determine that they're just not where they want to be from a valuation standpoint. But then they come away from this saying, look, I'm going to grow my value and I'm going to get there in the next year or 3 or 5 years. But now they know what the future looks like for them. And frankly, they also come away with a roadmap to grow value in the years ahead, which can be very valuable. On the other hand, we've had folks come through this and say they're literally shocked at what their business is worth and they wish they would have done this years ago. So again, a very eye-opening and worthwhile experience to go through. We are taking a ton of staffing companies through this exact experience today. In some cases, they're looking to sell in the near term, and in some cases, they're still 5 to 10 years out from that. So let's say you've gotten to the point where you decide to move forward. So what does the sale process look like? There's a value maximizing sale process. That's what we take most of our clients through. And I will tell you, it takes every bit of 6 to 9 months from start to finish. So as a business owner and a management team, be ready. It's a big investment in time and resources and energy. Now, partnering with the right investment banking and advisor partners is really critical, because our job is to take as much of that work off of your plate as possible to make sure that you and your team can be focused on maintaining and growing the business throughout the sale process, which is critical. Now, I will say that we've closed sale transactions in as little as 30 days. Now, I will say those are not value maximizing sale transactions. So in those cases, we've had a business owner that for health or other reasons, they want to be done in 30 days. And, you know, we knew kind of going into that eyes wide open, we're going to be leaving some value on the table. And that was the objective. But I think for most folks that are looking to sell their business one day, you want to be running a value maximizing sale process. The next point here is having a deadline driven process is critical. I think every business owner is probably getting phone calls today from buyers interested in acquiring your business. Be very cautious about picking the phone up, right? A lot of those are a waste of time. I've seen a lot of business owners that they call us and they say, look, I've been talking to this buyer for the last 5 months. They keep drawing out the process. They haven't given us a value. We keep sharing all this confidential private information, only to end up getting a lowball offer at the end. And so extremely frustrating, very distracting for the organization. And so that is why we run a very timeline driven process. And I'll kind of jump to that next. So we really customize our sale processes for business owners, depending on the size of the company, a number of other objectives. But the typical process starts with, typically it takes us about a month and a half, sometimes less time, sometimes more time, to really prepare to go to market, right? So getting your financials in order, getting a good forecast that we're all comfortable with, putting together the story of your business, the marketing documents, and then making sure that we've got a really strong list of prospective buyers, buyers that we think would be a great fit, and buyers that we know can close the transaction, right? So do they have the financial wherewithal to actually fund the deal? So that's our preparation phase. Once we're ready to go to market, we launch the deal to our buyers. And we don't ask them how much time they need. We're literally telling them, you have until this date to submit an initial proposal. Usually it's about 4 to 5 weeks out. So the good news from a seller standpoint is you find out very quickly, A, who's interested in your business and at what range of values. From there, we generally take that information. We decide to move on with a smaller select group of prospective buyers to move on to what we call phase 2. Phase two, we're giving these groups access to a data room, which means we're giving more information to fewer buyers for confidentiality reasons. We're generally having in-person meetings with the management team from the buyer and the seller group for the benefit of both parties. And really, we're then giving those groups another literally 5 weeks. It's a date on the calendar from which they need to provide their best and final offer. We typically call that a letter of intent or an LOI. And then we're signing one letter of intent and we're closing as quickly as we can. Typically, from the signing of a letter of intent through closing, generally about 3 months of confirmatory due diligence. So that's a very high level. Again, it's a 6 to 9 month process. There's a lot involved, and you're going to hear this a lot throughout this conversation. You really want to have the right team in place. And so we'll kind of skip the key terms. I'm going to kind of wrap up and speed through this relatively quickly, as I know the time's kind of ticking here, and I want to leave a little time for questions. But in terms of deal terms, you know, one of the most important ones is cash at close. I'll illustrate this in a couple different ways, but historically, if you're a seller of a staffing company, the general dynamic of the deal structure was you're getting probably 50 or 60% cash at close, and the other value is being paid out over time, typically as a performance-based earnout. So you're getting paid if and when you generate certain revenue and cash flow targets in the years ahead. Today, that number has jumped to as high as 90+%. So again, really good news for sellers. Unfortunately, what's good for sellers oftentimes works against buyers. So I've had a number of calls from groups that are looking to grow through acquisition in the staffing space, and they say, look, I'm paying a full turn of EBITDA or more beyond what the company is worth. So they're trying to overpay and try to acquire a business. And they're not moving on in the process. And my first question is, how much are you offering at cash at close? And they're sort of stuck in that 50 to 60% area. So as a buyer, it's really important to know the market and where and what terms are looking like today. So we'll kind of jump maybe to the next page because I want to kind of talk through, you know, really some tips from the investment banker's playbook for both buyers and sellers. And so maybe we'll start off with buyers. So assemble the right team. I think a lot of business owners decide, hey, I want to grow through acquisition. I want to buy some staffing companies, and they oftentimes try to do it themselves. And as Wiley mentioned, it's a very labor-intensive, low hit rate process, right? You're calling business owners, they're not interested, right? So you get a lot of no's. And so what ends up happening is upper management or ownership decide, this isn't fun. I'm going to pass it down to lower management. They start making phone calls. They're frustrated. They get burnt out. And next thing you know, you're not pushing forward on a buy-side search process. So we as investment bankers, we have a very fine-tuned machine to get to decision makers, get access to them, get to them quickly. You know, typically I say it takes about, for us at least, a couple of months to start seeing results. We have had to pause our outreach efforts in the staffing space because, as Wiley mentioned, so many business owners, or more so than was typically the case, are really interested in having a conversation about selling their company. So, so very active. Know the market. I kind of already touched on that. If you're a buyer, you really got to know. Doesn't mean you got to pay the high values. Doesn't mean you got to pay 95% cash at close. But if you're investing your time, energy, and resources in trying to acquire businesses, you at least have to know what the market looks like to see what you're up against. And, you know, play the game. I'm really cautious about this. I know most sell-side investment bankers hate this, including ourselves. But as I just mentioned, if you've got limited resources and, you know, you want to find out if you're even in the ballpark, submit a light touch LOI, right? Wiley's kind of giving you the playbook for some ranges for various subsectors before you dig in and spend a month or two doing due diligence only to find out that the seller has unreasonable value expectations. You know, work with an investment banker, try to figure out what's a range, let's submit something. And if we don't get invited, great, let's move on to the next one. And I've already sort of mentioned kind of feeling out the process, right? So from a seller's perspective, again, assemble the right team. We talked about that, whether it's going through a pre-sale preparation process. The quicker you can have conversations with folks that know the market, the better, right? And so I give a lot of credit to business owners that are talking to us 3-5 years or more before they want to sell their company, just to get smart on the industry, make sure they know what that process looks like, and really build value over the course of the next several years leading up to a sale. You know, pick the low-hanging fruit. Sounds crazy, but we've been late in the game. We've got an LOI signed, and the seller basically is telling the buyer that, look, we've got some low-hanging fruit we can pick, right? If I just made these quick fixes, I could increase margins by 5%. Unfortunately, the buyer's not going to pay you for that. They're going to say, well, it was that easy, you would have done it on your own. But a buyer is going to pick that low-hanging fruit, right? And they're going to gain that value. So again, getting ahead of the game, making those quick fixes months and years before going to market, makes sure and ensures that that value accrues to you as the owner. And then I mentioned kind of know what to expect. So finally, really the last page, right? What are the next steps, right? Take the next step today. So are you a buyer? You can still get a really good value for a staffing company in this market. It's been very difficult over the last 12 months as a buyer, where valuations and cash at close have been. But I think similar to the housing market, it's becoming a little bit easier to be a buyer today, right? In housing, I don't think anyone expects home values to start to crater all of a sudden. But I think with mortgage rates spiking, I think there's probably fewer and fewer people competing for these homes. And so I think it's easing the market a little bit from a buyer standpoint. As I said, if you want to grow through acquisition, at least have some conversations with a few investment banks, understand how the buy-side search process works. Again, that's a great example of taking a lot of the work off your plate. Are you a seller? Look to investing the time and energy into a pre-sale preparation process or evaluation. Again, you learn so much about your business. And in most cases, I think business owners that go through this really enjoy the process and really wish they would have done it years before. And finally, assemble the right team. Myself, Wiley, UHY Corporate Finance, we're always interested in having conversations with business owners, whether you're looking to grow through acquisition, whether you're looking to sell your business today or years from now, or just want to know kind of what the market looks like. We're always open to those conversations. So we've got a little bit of time. I don't know, Wiley, if we've got any questions that have kind of come in through the system here. But
no questions as of yet. But I think you can ask questions through the portal, even though everyone's on mute. No questions have come in.
Yeah, I think we're about out of time too. So we'll just flip to the next page. And, you know, as folks have questions, we've got contact details for both myself and Wiley. Feel free to send us an email, give us a call. Like I said, we're always happy to have conversations about what we're seeing in the market. And, you know, we do a lot in staffing, so we've got some good perspective and love talking to staffing management teams and owners. So appreciate everyone's time. And like I said, feel free to follow up with questions and feel free to reach out. Thank you.
Everyone.